how to handle their portfolios, what to do, what to do as times changes. And this is our commitment, and we intend to stick to this commitment for as long as is humanly possible. We've also committed to ensuring that we invite key stakeholders and the most knowledgeable people on whatever subject matter we choose to speak on at any of our webinar, which is the reason why most of us that have attended our previous seminar will have seen that the quality of our presenters, I make bold to say, are the topmost people within the Nigerian capital market and indeed internationally. So I will not want to preempt too much what our presenter today is going to speak to, but we believe strongly that the topic we've chosen is indeed a very, very important topic, because again, what we find is that when people get introduced into the stock market or get introduced into investments, some believe that, okay, look, all I need to do is just put my money there and just watch the money roll in. Some believe that, if I put the money there, the money is supposed to double in 2 weeks. And if they don't see the money double, they come and they start becoming apprehensive. That is the reason why we are brought our presenter today in order to explain to us how portfolio construction works and how to optimize the portfolio such that you get the best returns. There's no investment in this world that does not have risks. And because the investments in the stock market and the capital market also have risks, it is important that we optimize those portfolios such that we will minimize risk and increase the return obtainable as much as possible. So it's really our pleasure today to bring you the presenter we have. By way of short introduction, is someone I've referred to as the head teacher of the Nigerian capital market. And the reason why I say that is that he happens to be the managing director, CEO of the institute that not only trains but gives certification or qualification to every single one of us that are practicing as either stockbrokers or capital market organization, capital market operators in this market today. So you can see that we've actually reached for the very top in bringing him to us, and we feel that to all intents and purposes, he is the right person to come and talk to us about this subject, because obviously, it's always good to have the teacher's teacher. I will not preempt him too much. Tolu is still going to tell us a little bit more about him before we bring him in. All I will ask is that please let's pay attention. I know some of us are at work, but we can still be listening to this while we might be doing whatever activity we are doing. And I can assure you that we will leave this webinar today having gained some very, very important insights as to how to optimize our portfolio. So I ask that you please sit back, enjoy, and at the end of the process, our presenter will be available to also take and answer your questions. You are welcome once again, and thank you so much for joining us.
Yes, as you heard our managing director talk about our guest speaker, we are going to be diving more into his profile right now, and he's going to be breaking down all that we need to know about optimizing our portfolio today. I would enjoin us to kindly put down our questions as we listen to him speak. And also, for those that have questions that would like to ask questions, you can use the chat box. And after the presentation, we're going to be having just a brief other short presentation about the different makes of asset class from Otto Stephen itself. And after which the floor will be open for people who wants to ask the question verbally by themselves, and those who would have dropped their questions in the chat box. So right about now, sit back and listen to the profile of our guest speaker, a man of great wealth of knowledge of the capital markets. Dr. Emomotimi John Agama is a chartered management accountant, economist, investment analyst, a chartered stockbroker, and a risk manager. He is currently the managing director at the Nigerian Capital Markets Institute, NCMI, a subsidiary of the Securities and Exchange Commission. He was previously the head of registration, exchanges, and markets infrastructure and innovation department. He is also a special assistant to the executive commissioner operations and head public offering at the Securities and Exchange Commission, where he superintended over fundraising of most companies. Dr. Agama was a secondee to the United States Securities and Exchange Commission in 2018. He is a ranking member of the Rules Committee and a member of the SEC Committee on Adoption of IFRS in Nigeria and the SEC Arrowhead for the introduction of derivatives trading in Nigeria capital markets. Prior to joining the SEC, he was at various times with the University of Benin and the Office of the Accountant General of the Federation. Dr. Agama is a fellow of the IFC Milken Institute's Capital Market Program. Dr. Agama holds degree in accountancy from the River State University of Science and Technology, Port Harcourt, a master's degree in banking and finance, and another master's of science degree in economics, both from the University of Benin, Benin City, Nigeria, and a PhD in economics with distinction from the Nile University of Nigeria, where his PhD dissertation was titled Impact of Cryptocurrency Operations and Macroeconomic Variables in Nigeria. He holds a graduate certificate in capital market from the George Washington University, Washington, D.C., USA. Dr. Agama is a graduate of the International Housing Finance Program of the Wharton Business School, USA, New York Institute of Finance, Corporate Analyst Program. He holds Advanced Risk Management Certificate from the University College of London and Prima, a graduate of Strategic Enterprise Analysis and Prince 2 Project Management of the SEC, York University, Toronto, Canada. He is a graduate of Duke University, USA, on FinTech and Policy. Dr. Agama is a member of the Chartered Institute of Management Accountants, UK, a Chartered Global Management Accountant, Chartered member of LIFA USA, member Chartered Securities and Investment Institute, London, associate member of the Association of Chartered Fraud Examiner, ACFA. He is a senior fellow of the Risk Managers Association of Nigeria. He represents the Nigerian SEC as a plenary member of the Regulatory Oversight Committee of the Global Legal Entity Identifier, where he also sits on the board of the Global Board as a vice chairman. He has led various initiatives at the Nigerian SEC, including serving as the project manager for the Nigerian Capital Markets Master's Plan from 2015 to 2025. And which means that he is still on that project until 2025. He is a major driver of the resuscitation of the commodities markets, a fintech enthusiast, and a global contributor to the fintech discourse. He is also a knowledge disseminator servicing as a faculty member to various institutions, including the Chartered Institute of Stockbrokers, CIS, and Institute of Chartered Accountants of Nigeria, ICANN. Dr. Agama served as regional executive member of the Chartered Institute of Management Accountants, CIMA in UK, and the chairman, board of trustee for Purity Rose Orphanage Home. Join me in today's webinar as we welcome Dr. Agama to disseminate more information to us. And I'm sure that by the end of this webinar, would have had a lot to jot down and to learn from this session. Thank you so much. Let's have Dr. Agama right now. Thank you, Doctor.
Thank you so very much, Tolu, for that introduction. I thought you were talking about somebody else, not until I hear you call my name. It will have been my wish that we didn't say all of those things. But anyhow, Thank you for the opportunity, and more importantly, for my president, for the opportunity to come and share knowledge. As we have said earlier on, this is a knowledge market. But when your president calls you, you cannot but answer him. Otherwise, I would have told him that I wouldn't come. So I don't want to lose my certificate yet. So I necessarily must be here. And more so, for me, it's even more important because we're in a season where people are finding it difficult to make choices. And they're not able to make choices, not for any other reason, but for the fact that, they probably don't have the knowledge, the wherewithal to be able to make those sound choices that they need to make. Choices needs to be made properly and guidedly, especially at these times when things are difficult. These are not the times where you gamble. These are the times where you are very, very discreet. And of course, you make sure that the information you have is enough to give you a good choice, or yet still a bad choice if there is no other way out. But what we are looking at is the best bad decision or the best good decision. That's exactly what we are looking at, and that's what optimization speaks to. So the president mentioned something which is apt, especially in a forum like this. There is actually no investment that does not have a risk. To say that an investment is risk-free is a fallacy, really, because even governments, governments and government bonds are not risk-free in the real sense of the word. So clearly, there is no investment that is risk-free, really. But the degree of risk matters. Of course, optimization speaks to your ability to reduce such risk in order that you get the best of both worlds. That's what optimization speaks to. And that's why we are here. I am a teacher, and I'm proud to be a teacher, happy to be one, because that's, for me, it's a noble idea, it's a noble ideal for anybody. Being a teacher, you are able to share knowledge, and being able to share knowledge, kind of spurs you to even reading more. So permit me this afternoon to share. I have a very huge slide, but what is interesting is that I will not speak to all of the slides so that we can have enough time, to have discussion. Probably we'll run through some, but clearly, the idea is to rub minds. So what is the topic today? Investment ideas to optimize your portfolio. Clearly, these are just ideas. They are not foolproof. That's the word. That's why it's called an idea. An idea is something that you have in the thought process, knowing fully well that, it could be countered. But be that as it may, it is indeed important that we understand exactly what we intend to achieve. Investment ideas to optimize your portfolio, strategy of building wealth And more importantly, like we said earlier, managing risk. You cannot run this without managing risk, right? So if you want the best, investment advisor or investor or, project manager will be one that understands the risk that surrounds him or her. And those risks are important to know. And once you know those risks, then you are able to deal a blow to the challenges of life. And of course, the webinar is set out in various, areas, various forms, in order that you can have, enough material even after now to go through. So it is introduction, definition of investment, importance of portfolio optimization, identifying short and long-term goals, risk tolerance assessment, the SMART goal framework, allocation and allocation, which speaks to diversification and to benefit, allocation strategies, moderate portfolio theory. Permit me, because I'm a teacher, I need to be detailed enough so that people can have something to go with. The idea of being here is that you share knowledge and people are able to take the knowledge away and make a meaning to themselves. So clearly, it is a privilege for me because other people are better than I am. However, I have been given an opportunity this afternoon to come into your space. And please allow me this short time to come into your space to disturb you, right? Revoluting your mind around, investment ideas that you require to optimize your portfolio. I said in my LinkedIn page, the year is ending. The year is rolling by. This is 11th month in the year of the year of our Lord 2023. And not just that, today is 28th of November. Wow. In 2 days' time, we'll cap November and we'll jump into December, which simply means the year has ended. So what better time for a topic like this, for you, for me, to start looking back, taking a step back to say, what have I done in the previous year or this year that is ended? What have I gained? What have I lost? How did I go about it? What were the challenges? What were the problems? What are those things I didn't see that I could have seen if only I had gotten, some guidance? And so you have professionals right here. I've seen some of them, some of my very good friends right here. And I know they know already some of these things. Why are they here? They are here to do an assessment that will help them look at exactly what they have done, what they have done wrong, what they probably have done right, pat themselves at the back, and then move on. So we talk about long-term and short-term investment, strategies for different time horizons, role of compounding, outline brokerages, investment news sources, financial analysis software, recap of key points, basically, to tell you exactly what we'll do if we get there. So what is investment? So that is the first question. When we are talking about investment ideas, do you really know what investment is? Because if you really don't know, why then will you have to be in it? One of the major issues that brings about crisis, especially in our investment space, in where people are not knowledgeable and they go into what they are not knowledgeable about, following what you call the head, theory. If you follow the head theory, you only move where others are going without exactly knowing exactly what is there. Only until you get there, and it could just be a hole. So it is important that we understand what it is when we talk about investment. Investment involves committing money, time, or resources to an endeavor with the expectation of earning an additional income or a profit. It plays a crucial role in building wealth, achieving financial goals, and securing one's financial future. Time, money, or resources to an endeavor. What time, what money have you put aside for this activity? So one of the things you have done is You have invested now that you are here because your time you have brought in here to learn in order to do what? Improve something, earn something, earn additional income, earn profit, name it as the case may be. Towards what? Your financial future. What better time will we have other than now to start talking about our financial future? What better day will it be other than today? Or it did even yesterday. So, an investment is also said to involve putting capital to use today in order to increase its value over time. It requires putting capital to work. Cost, time, effort, all of these are critical in making this happen. And it is so important that once you are able to understand this as your cardinal objective, getting it done will not be a problem anymore. It speaks to the issues around what we call baby steps. What are those baby steps? Those baby steps must be deliberate, must know clearly what you intend to achieve. However, in doing that investment, it could be done in several ways. But when you speak about a portfolio, the next thing my mind comes to is a portfolio. For the very old ones here, you will not forget in those good old days when you talk about portfolios. So, portfolio, they are similar. So a portfolio investment is a passive owning position in an asset, but with the hope that it will increase in value, generate income, or both. Indeed, a portfolio is a collection of financial investments like stocks, bonds, cash, commodities, cash equivalents, including closed-ended funds, exchange-traded funds, and all whatnot. I call it a potpourri. In your local terms, you call it ngwangwo. That is to say, it is an orishi-rishi, where you have komo, you have shaki, you have a body, you have, ishon. Name it. Just choose the one you like. If you could visualize those beautiful stew around, then you will understand exactly what we are talking about. Those beautiful stew that is red with all of these, exercising, delicacies. That is what a portfolio is. If the stew is not sweet, it's not red, it's not beautiful, then it's not a portfolio. That portfolio is when you look at it, you savor it. So the same thing applies even to this, to what we are speaking to now. In your mind, you must virtualize that portfolio. And the joy that portfolio gives will be a psychological benefit in understanding exactly what you are talking about. And that is critical in your decision. So for you to optimize your investment idea, you must first picture exactly what your thought process is. And imagine where you do that, where at any point in time, you visualize that and you are smiling. From your heart comes this smile that expresses exactly how you feel. Wherever you look at your portfolio and what you find in at your face, or what stares you at your face is anger, then know there's a problem. You need to begin to do what? To rethink your portfolio. To rethink your portfolio, to rebalance your portfolio. Critically, that is what you need to do. So, for me, it is important to lay these down in an attempt to bring you to that point where you understand exactly what you need to do. Building a well-structured investment portfolio is the cornerstone of financial success, and a key strategy in this pursuit is diversification. So, if you want to succeed financially, you must think about diversification. What is diversification? It's spread. Are you diversifying or are you concentrating? Is your hope, your desire, your actions tailored towards one point or towards multiple points? By spreading investments across various asset classes and sectors, investors aim to do what? To minimize the risk and maximize potential returns. However, crafting an optimized portfolio involves more than mere diversification. It entails a thoughtful consideration of various investment avenues and strategies. So, what are we saying? We are saying that, yes, you need to construct a portfolio, a structured portfolio, something that you can actually be proud of, moving from different asset classes, not concentrating in one place and concentrating your risk. You must do what? It must involve thoughtful consideration of various investment avenues. One does not end without the other. So it is important that as you do this, you know exactly what your intents are. In fact, what I do as a person, my investment portfolio is considered within an investment committee. My investment committee is my household. Sometimes great decisions come from sources that you least expect. So, in doing this, you must begin to think outwardly. So say, this is what I want to do, and this is why I want to do what I want to do. You probably will have a question that nobody else will have asked you. But that person whom you don't consider to have anything will be the one asking. So you need to set your financial goals. And when setting your financial goals, you have to consider the following: identifying short-term and long-term goals. Do a risk tolerance assessment and have the SMART goal framework. Why do you have to do this? We are not all the same. Forget that we are in the same class. Forget that rain, when it falls or when it rains on all of us. Forget that when it shines on all of us, irrespective of your age, your size, your length, your width. But because we are not all the same, we have our peculiarities. And in our peculiarities, there are benefits and there are also disadvantages. Hence, you must, on your own, don't follow the Joneses. In optimizing your investment idea, you do not do what? Follow the Joneses. You don't do it because they have done it. You do it because it is beneficial to you. And so, you must identify your short-term and long-term goals. Don't go and paint your house when you have school fees to pay. The paint will not solve anything, but the school fees will bring latter gain. So this is what you need to. You must be both traditional and conventional when you make your decisions around investments, for you to be able to achieve the goal that you ought to achieve. And in identifying short-term and long-term goals, you are asking yourself, where am I going? Because it is a crucial first step in creating a successful investment strategy. Understanding the difference between these goals and how to set them effectively can help you tailor your investment approach to achieving what matters most for you. Because it is what matters most to you that will give you the comfort you need. And so, before embarking on your investment journey, it is essential to define your financial goals. Are you saving for retirement? Are you buying a home or funding your child's education? Short-term and long-term goals require different investment strategies. These goals should align with your personal value and priorities. I dare say, for parents, what will be your first, your critical goal? One thing that should be your critical goal, if you are in the middle age, is making sure that you are able to pay fees, tuition for your children. How stupid will a man be that is making investments and his children are sitting at home? That is your priority. So you can actually invest in education-friendly investments that will help you achieve that goal. For every goal, there is a friendly investment that speaks to that goal. So your investment strategy should reflect your short-term and long-term goals to help you achieve your financial aspirations while managing the risk around it appropriately. So once you are able to do this, it is a foundation. Because I've never seen anyone who decides to start building his or her home in the air. There is always a foundation. That foundation must be fixed. And it is in that foundation you are able to start where you have to start from. Yes, Olasukami for Lawrence Oladeji, you want to ask a question? Please go ahead. Are you asking a question or this? The hand is up by accident. All right. Okay. So short-term financial goals are those goals you aim to achieve in the near future. Typically, within 1 to 3 years, you have told yourself this is what you want to do. These goals are usually more concrete and immediate and can have a significant impact on your day-to-day life forever. For example, as a young person, one of the critical things you must learn to do or learn to work towards is owning a home. Because if you own a home early, then you'll be saving the rent in the future. If you own a home early, you'll be saving the rent in the future. So your investments, your early investment, critically, especially when the children are young, will be towards owning a home. So that your rent will become savings of the future. And of course, it gives you both psychological stability as you go on. Your long-term financial goals are those you aspire to achieve over an extended period, beyond 3 years. What do I want beyond 3 years? Indeed, it is said, the day you get your employment later is the day you start to plan for your retirement. Optimizing investment ideas. The day you get your employment later is the day you start to plan for your retirement. Oftentimes, people don't do so. And that is why, for public servants, a lot of them miss it. And by the time they retire, they die quickly. Because life gives them a blow that they're not able to sustain. But it's not late. So we'll look at it. What else are you expected to do? Risk tolerance assessment. What is your risk? How tolerant are you to risk? Do you have hypertension? If you have high blood pressure, there are some securities you cannot invest in. Otherwise, you will just die. So you must understand the psychology. You must understand everything around it. Are you comfortable with a higher risk, higher reward strategy? Are you a daredevil? Don't because Shola is a daredevil, you claim to be a daredevil. You will die, and Shola will be smiling. And it doesn't matter who you are. It is interesting because you must know it in optimizing the investment ideas. Or do you prefer a more conservative approach? Your risk tolerance should guide your asset allocation decisions. Not everybody can take it. Not everybody can carry it. And what you must understand, even in all risk tolerance assessment, is that once you are unstable, you cannot make good investment decisions. The minute you are unstable, you cannot make good investment decisions. So you must watch it. Don't dare what you know you cannot do. Don't just follow people just because you want to be like them. So assessing your risk tolerance is a critical step in creating an investment strategy that aligns with your financial goals and comfort level, your comfort level. It helps you determine how much risk you are willing to take on when investing. Risk tolerance can be very significant from one to another. That is what I said earlier. So, without wasting so much time, you must understand that whatever you want to do must meet a SMART framework. Specific, measurable, achievable, relevant, and time-based. You don't build castles in the air when you are doing investment. You don't build castles in the air when you are doing investment. It must be smart. You must know exactly where you are going to. You may not achieve it, but you may come close to achieving it. Hence, you have the opportunity of an assessment or a review. That is crucial. And with asset allocation, diversification and its benefits. Once this is done properly, you are able to enjoy the benefit of a spread. Because within it, when there is one bad one good one is lifting the other. So that is how it works. If you want to go far, if you want to go fast, what do? You walk alone. You are there. But if you want to go far, you must go jointly. You must move together. Again, our local parlance says, now cooperation I make rice full pot. Cooperation is the diversification. Because when you boil a cup of rice, the rice is on the floor. But you put water and it's heated, what happens? It swells up. It is that cooperation that makes it to swell up. So it is with the portfolio. It is the cooperation of the portfolio that increases the value of that portfolio. And that makes the difference. So as you do this, you are creating, strength for yourself. In the allocation strategy, you will explore various asset allocation strategies, such as modern portfolio theory. Some of them are a bit sophisticated, that aim to find optimal balance between risk and return. The specific allocation you choose should align with your risk tolerance, investment objectives, and time horizon. Because it is critical that you put all of this into play. I won't bore you with Markowitz, but it's available for you to read. This is one of the widely used, sophisticated investment allocation strategies. And it was developed by Henry Markowitz. It focuses on achieving the highest possible return for a given level of risk, or minimizing risk for a given level of return. Indeed, this is the basket theory. Basket theory, because the central idea is for the MPT to combine different asset classes. And so it is important. Other strategies that we have are risk parity allocation, where you look at the risk vis-a-vis, the assets. So you allocate assets based on the risk contribution of each asset class rather than market capitalization. The goal is to create a portfolio where each asset class contributes equally to the overall risk. There is appropriate allocation based on risk. Because you know what your risk tolerance level is and your risk tolerance index. So you calculate what I call the risk tolerance index that allows you to appropriately allocate that. The other strategy is to have a factor-based strategy, which allocates investment based on specific investment factors, such as value, growth, momentum, or quality. Factor-based investing can be used within asset classes to enhance returns or manage risk. Geographic allocation requires allocating investments across geographic regions or countries, depending. But in this instance, our forte or our interest is local. But once you are doing international investment, then this comes to play. Market timing is important because you attempt to allocate investment based on market timing, which involves making decisions to buy or sell assets based on expectations of short-term market movements. In this, what you also use, which is not written here, is scrapping, because you are watching the market like an eagle, making sure that you know exactly what is happening. And this is the essence of employing or engaging a professional. One thing that a lot of people have lost is wanting to do these things themselves. No, if you are not a professional, sorry, it's like being a carpenter and you want to administer injection. What will happen to the patient? Of course, a carpenter that wants to administer injection will give injection to the head for somebody that has headache. The result is best imagined. So for active and passive allocation, you decide on whether to allocate assets actively, selecting the various stocks, or passively investing in index funds that covers your security. But of course, active allocation requires more effort and expertise because you must be detailed and individualistic on each investment you want to do. Also, you have alternative investment for which you are free to allocate portion of your portfolio into, like private equity, hedge funds, real estate. This can provide diversification and potentially reduce correlation with traditional assets. In all of this, it's important that we mention, without so much effort on it, what stocks, what investment vehicles are. For example, stocks, bonds, real estate, commodities. These are all investment vehicles that most of us are familiar with. Mutual funds and ETFs, these are all what we are familiar with. Of course, index funds and exchange-traded funds offer exposure to a broad range of assets by tracking specific indices. They are cost-effective due to their passive management style and provide diversification within a single investment. Alternative investment, I won't want to go too much on this because of time. Private equity, hedge funds, venture capital. Some of them, most of them, at least, I know private equity and venture capital, they are just developing in this space. Hedge funds, well, most of the hedge funds that operate here are usually international. Hedge funds, we call them hot money because they run in as they run out. They run in as they run out. So for private equity, we know they are builders with the intention of exit at a later time. And of course, venture capital usually invests in startups with the potential of significant growth. In all, we are speaking to the opportunities that does exist. And you move further, you have alternative investments, commodities like gold, silver, and of course, the dreaded cryptocurrencies, in as much as it is not legitimized, so to speak, even though it's legitimized the other way around. But of course, for you to enter any of these kinds of investment, you require knowledge. The managing director mentioned it. And you probably will not understand or think about it that way. But because we drive a knowledge industry, the capital market is not, the armchair kind of business. No, it's not. It's not the armchair kind of business. It's not a taboo. No, it's not. It's not a betting game. No, it's not. It is knowledge driven. You don't know it, you don't know it. If you don't get it, you forget about it. That is why it is important that occasions like this provide that knowledge that we probably would not naturally get into or bother about. So we talk about geographic diversification. For me, because we are talking local, I don't bother about that. But diversification involves spreading investment across different asset classes and industries. The strategy aims to minimize risk by not relying heavily on the performance of one particular sector or one particular investment. You must choose, put them together, and you enjoy it. I don't know if you are like me, but in those good old days, when I was a younger man, because I think I'm still young, I used to like the mix of ogbono and egusi together. So you have that, and it is not too one-sided. Of course, if you lived in Lagos, you know that oftentimes it is ewedu and gbegiri. That is a perfect or a near perfect combination. This is what it is, even in investment diversification. Capital market is a living subject. It's only when you relate it that you are able to understand it. So relating it is critical for you to be able to understand and to know exactly what you need to do. For geographic diversification, fortunately, most of our industries are concentrated here in a particular region, which is the West. Few industries or few companies are out of Lagos. If they are near Lagos, they are around Abeokuta, Ogun State, and that is it. So that is the hub of it. So when you speak geographic here, it's more an international phenomenon than a local phenomenon. And so, but even so, it is a point to consider. It's a point to consider because you may find yourself in those situations where you probably will need to be speaking to such parameters. So in understanding the parameters that will guide your decisions, you need to take all of this into consideration. But one important point that we won't run away from is sector and industry analysis, where you identify promising sectors for investment. You don't just go into any sector just because your head is crashing you. No. You look at the times and you follow the times. For a sector that is dying, why will you go there? A sector that is near grave, why will you go there? Why will you invest there? Something that is no longer, acceptable or no longer fashionable. I wonder which of us here will go and invest in Kodak, if we still remember Kodak. Polaroid, that they used to take pictures like that. Who will go and invest in such? But the catch area today is what? Tech. As of today, you can hardly go wrong with tech. So, in doing your analysis, you must understand economic trends. You must understand technological advancement. You must understand market demand, regulatory environment, global and political factors, environmental, social governance considerations, which is becoming major. You need to analyze industry trends because it is very crucial in the making of informed business decisions. Whether you are an entrepreneur, investor, or a professional in a particular sector, you must understand this and know how to do them effectively. In doing this, you need to collect data, market research, consumer surveys, competitor analysis. Of course, what has happened and has made this easy is that in doing all of this, including economic indicators, some companies, research analysts, are able to provide this information in one swap. And premised on that, you are able to take your decisions quickly. What more important thing should you do? Risk management. Because investment always requires that you assess the risk. Investing always involves some degree of risk, and understanding and managing this risk are essential for making informed market investment decisions. Here are some of this risk. Market risk, price fluctuation, risk that affects the entire market, often stemming from economic downturns. You know that a commodity is not selling anymore because people's income has been deflated. Inflation has caught up with people, whereby disposable income is so low. You know that some commodities you cannot buy anymore because they are more of imported items. And the FX volatility has dealt a blow and increased the prices that they are no more affordable. So people are looking for alternatives. Why would you go and invest in such companies? Interest rate risk, credit risk, where you have defaults, liquidity risk, market liquidity. These are the points. I wish I had all day, and that's why I'm just mentioning them. Inflation risk, currency risk, political and regulatory risk, business and operational risk, financial leverage risk, sector industry risk. These are critical. They are important. They are useful. They are necessary in this journey. However, in all of this, you speak to the principle of hedging. And what does hedging require you to do? Hedging requires you to take some decisions. that take a position in a related security to offset potential losses in the original investment. Because by hedging, you are as if you are wedging. You are wedging your fall when you hedge. Because so that your fall will not be too bad when it happens. Because the likelihood of a fall is something you sometimes cannot project. So primarily used to reduce risk by taking a position that moves in the opposite direction to the primary investment. It utilizes instruments like futures contracts, options, forward contracts to create that offsetting position. So combining stop loss orders and hedging is an important principle where traders often use both strategies together for a comprehensive risk management approach. A trader might employ a stop loss order on the primary position and simultaneously enter a hedging position to mitigate potential losses. These are strategies that can be employed in dealing with a potential loss. Because in optimization, we are speaking to the fact that you must take note of the future challenges while addressing the future opportunities. So, and in doing so, you must calculate very well. Having said that, you need to understand what kind of investing are you doing? Is it value investing or growth investing? Value investment is an investment strategy that involves selecting stocks that are believed to be undervalued relative to their intrinsic or fundamental value. Some people use that. But while you are doing that, you must be careful, knowing exactly what you are doing by properly assessing that security for you to take those decisions. It is not on the surface, because if you don't know it, you don't know it. But what you require is education. And of course, Benjamin Graham, a famous investor, and the father of them all, Warren Buffett, applied these principles. A lot of other people have also applied these principles. Even locally, we do. So it's important that you do an analysis. So it requires that, because when you go through this some form of investment, over time, you must be ready to stay long in this kind of investment, because the benefits do not come just exactly and immediately. So if you are in a hurry, then it is not for you. So the principles of value investing requires intrinsic value, knowing exactly that the true worth of the company's stock is often determined through fundamental analysis. And value investors seek stocks trading below their intrinsic value, providing a margin of safety. Fundamental analysis requires you to do a lot of work. The analysis focus will be to emphasize analyzing the company's financial statements. And perhaps for those that are not initiated, you have fundamental analysis and technical analysis. These are the analytics used to assess investment. The metrics in this situation include low price to earnings ratios, low price to book ratios, and strong dividend yields. And that's why we say that if you don't know it, seek advice. Seek advice. Seek professional advice. What is your horizon? Is it long-term or short-term? Under value investing, it often involves a long-term approach. That's what I said earlier. Patience is the key to value investment. You may go against the market. Everybody is going southward, you are going northwards. All you are looking at is what others are not looking at. You buy low and you sell high. The topic again is ideas that optimizes your investments. And so, you need to follow them critically. You need to look at the risk and challenges. And therein are the value traps, where the stocks may appear undervalued, but could be in decline for fundamental reasons. There are stocks you know, in your own presumption, are undervalued. But, of course, they still go down. You now start asking why. You must determine market timing. Determine the right time to enter is fundamental. And the only way you can determine so is when you are alert. Oftentimes, as investors, you cannot be alert because you don't have the time to be alert. So you need to pay somebody to be alert on your behalf if you are really interested. Growth investing requires that on selected stocks of companies expected to experience above average growth in their earnings, you look at what they are doing and the potential that is there, the potential energy that is there. For growth investing, you're looking at earnings growth, innovation and market expansion, high valuation tolerance. These are the things you are looking at when you are looking at a growth investing strategy. Reinvestment of profits, risk and volatility, top-down approach. Growth investing requires a keen understanding of the growth prospects of the individual companies and industries. This is crucial in taking this approach. So, for you, you must understand this. But it could just be a mix in the sense that it may be an undervalued stock, but still has the potential of growth, which means it's a combination. And of course, there are techniques in addressing all of this. We have spoken about identifying undervalued stocks, so we don't come back to it. And of course, for dividend stocks, it is clear. How much does it bring? Steady income stream, potential for dividend growth, historical stability, and participation in stock appreciation. All of these are critical and important in taking that decision. So when you are evaluating your investment performance, the metrics that you need to use basically are return on investment, ROI, risk-adjusted returns, earnings per share, price to earnings ratio, dividend yield, debt to equity. These are fundamental concepts that require days to assess. And in it, also, one of the things that you must look at, even though not particularly available in our client, is tax-efficient investing. Investment that will help you reduce your tax liabilities, tax assets, efficient asset allocation, and of course, tax loss harvesting. These are concepts of the future. So, as far as I'm concerned, making a decision around your investment also speaks to your behavioral content. And what is that? Because there is what we call cognitive biases in investment. And it refers to systematic patterns of deviation from norm or rationality in judgment, often leading to perpetual distortion, inaccurate judgment, illogical you see people, they oftentimes, they just continue making mistakes. Not that they are not intelligent, but their judgments at those particular times are flawed. Sometimes, some of those irrational decisions now come to become the positive, parts of it all. So developing a rational, disciplined approach to investing is crucial for long-term success. Don't take a decision when you are under influence. Whatever influence, I don't know. Overconfidence, loss aversion. These are, behavioral issues that are important and useful. You have the gambler's fallacy, availability bias, endowment effect. These, are all behavioral tendencies. I have special interest in behavioral economics, hence I'm bringing all of this. But in doing this, to stay disciplined, you must establish clear goals, create a diversified portfolio, develop a solid investment plan, stick to a long-term perspective, automate your investment, rebalance regularly, juggle the balls, avoid emotional decision making. Don't make a decision on investment when you are quarreling with your wife. And woman too, don't make an investment decision when you are quarreling with your husband. So it's important. But in all, we must do ethical and socially responsible investing. Is the spirit of the day. It involves considering not only financial returns, but also ethical, social, and environmental impact of such investment. Some will say, this is not for our client, but it probably is worth considering. Because if you do not do so, all of these may affect you. Imagine that in December, the rain is still heavy, even in Abuja. Then it tells you that climate change is real, climate finance is real, and so it becomes a necessary item to consider when making these decisions. So without much ado, I believe that we have covered enough to be able to end this topic or this webinar. But while I gloss through the others, I will not fail to say that for you to achieve the best of all things, you require education. Continuously educating yourself about the different investment opportunities, economic trends, and market dynamics empowers you to make well-informed decisions and adapt to changing conditions. For me, it is education, 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 education. And that education is crucial, important, and necessary. You cannot stop educating yourself. The last time you stop educating yourself is when you are below 6 feet. And that time, I pray, is still far for all of us. And so, please, while we continue to create opportunities for ourselves, we must continue to learn how to protect those opportunities. And in protecting those opportunities, we must continue to have education. I believe strongly that in all of this, the intent is that we have a better future and indeed have a better economy that will support our desires, our goals, and our aspirations. Nigeria is a work in progress. What I know is that the opportunities in this country are limitless. But what we all require is to have an open mind to be able to dig into those opportunities and bring out the jewel that is buried below. On this note, I want to thank you for being here and for listening attentively. I hope that I've been able to share something that will make value, that is useful, that you can refer to, that someday, somehow, will make a meaning to you as you progress in your investment culture and life. Thank you very much for having me, and God bless you.
Wow, wow, wow. Okay, you know, I said that Dr. Agama is a lecturer.
You said this, sir.
And a lecturer will not fail in delivering any day, anytime.
Wow.
I found myself going back to taking notes and jotting down things. What Dr. Agama have done for us this evening is to essentially take us through the process of investment from 0 to 100. Unfortunately, this is an online program, so I will have requested a standing round of applause for Dr. Agama for the wonderful work he has done today. But all I can say on behalf of every single one of us that have made that time to join this webinar today is to say thank you, and thank you so much for this. The fact that you even found time to prepare these slides, I mean, we're talking of 114 slides. You will agree with me that only a lecturer will be able, I mean, the notice we gave Dr. Agama wasn't that much. And look at it, 100, this is essentially a handout of an investment that Dr. Agama has given us for free. So thank you so much, Dr. Agama. I've learned so much. In fact, I've picked some of the things that you have said today. I've picked them. I'm going to use them in my private life. I've picked SMART, specific, measurable, achievable, relevant, and time-based. I will print it in a large signboard and put it somewhere in my office so that I don't forget. So I can use it to be reminding myself when I'm making investments and when I'm advising people. You also mentioned, don't make investment decisions while quarreling with your wife or your husband. It might sound like a joke, but it's a very, very important advice because investments involves money, and it is better not to take decisions about money when one is emotional. He also compared our portfolios to portmanteaus. Couldn't have described it better myself. Because that is what it is. It's a portmanteau is where we put our valuables, and it contains so many things that we value. And essentially, that is what a portfolio is. So when we talk about portfolio, I think that Dr. Agama have been able to help us to describe it the way a lecturer will describe something such that students will be able to understand it. So thank you so much, Doctor. We really, really appreciate your what you've done for us today. Please, we will ask that you still please hang around for us. Tolu is just going to speak for a few minutes. Then we'll quickly go to the question and answer session. I've seen so many comments on our chat room already, but I will allow Tolu to just speak for a few minutes. Then we'll go to the question and answer. I will ask that everybody, whatever question you have about the capital market, whatever question, even if it does not have directly to do with the topic in at issue, Dr. Agama, even from his CV, we will say that he's more than capable of answering those questions for us. So please hang around, and after Tolu's short presentation, you can ask Dr. Agama, and I'm sure he will be glad to answer you. So Tolu, please go ahead quickly.
Thank you, Dr. Agama. That was quite a robust presentation. And thank you for that summary, Mr. Amolegbe. So quickly, I'm not going to, brush over anything anymore. So I'll just quickly talk about some of the asset classes that each of us can actually invest in while trying to constitute a portfolio, right? And afterwards we can ask questions. So we have just a few here. We have fixed income instruments, we have equities, we have commodities, we have currencies, right? But currency is quite a very tough asset class that anyone can trade, right? So that is not included here. And we have cash and equivalents, anything, it is also good to have some cash stock stashed somewhere just in case of emergency, such that people do not think you have to invest all the money you have at hand. And so for fixed income instruments, these are debt instruments issued by banks and large corporations. We've at some point, everyone must have, everyone knows about the federal government bond, the FGN bond, the savings bond. People also should know about commercial papers from large corporations like MTN. We had some commercial papers from MTN recently. We have from different companies like that, Dangote Cement and all. So we have equities. Equities is investments in shares. Like we all know, you want to buy shares of this publicly traded company, Lafarge, Dangote Cement, Dangote Sugar, MTN, UBA, and many of this what's it called, publicly traded companies. And doctor has actually explained to us what we should look out for in those companies before we invest in them, and also some other things like the fundamentals that we need to check. So we're going to be having some stock recommendation quickly in this short presentation. We have commodities. This is when you invest in either any commodity such as gold, silver, platinum. We have even agricultural products that people can invest in. Also, this is also not a very common investment among people, but it requires professional advice to also put money in this. Then cash is the money we have at hand that we have stashed somewhere in the bank, and maybe other equivalents that can quickly turn into cash for us. So doctor, I've actually explained the steps to optimize our portfolio, and one of it is the techniques. You need the techniques of measurement that you need to put in place. And as I said, investors won't really have time for all of this. That is why houses such as Otto Stephen are here to help you in making actually calculating all of these techniques, using all of these techniques, and choosing the right portfolio or the right assets that can be in your portfolio for you. So for the returns that you can easily get on all of this on some of these portfolios, for equities, this particular one, this percentage you're seeing here is from the beginning of the year till this current moment, at least till yesterday, right? So the return so far, that's if you have a range of shares that you've invested in from the beginning of this year till date, you would be having returns close to this particular 39.92%. And for those that are investing in fixed income, like the commercial papers that I've mentioned earlier, we've had some that have at least up to 17% implied yield on them, but mostly most of these fixed income instruments are below 18%. Given the federal government auction results that we had in the month too, The highest was around 17 point something percent. And for commodities, using gold as the basis of judgment here, the year to date has been relatively below 11%. And for mutual funds, depending on the house that actually package a mutual fund, you're going to be having roughly between 10 to 20 something percent for mutual funds. And mutual fund is here because we have some other assets that people can invest in. So they are packaged financial products from all of these assets basket, maybe from some what's it called, equities. So we have other package investments that assets that people can invest in. Mutual fund is one of it. Exchange traded fund is also one of it, right? So let's quickly delve into something very important. This is like the icing on the cake for everyone present here in this webinar. So you want to invest, right? What proportion of your money should you put in this asset classes, right? So this is not cast in stone. This is not saying that take this as we have given it and you apply it. You also need to consider your own objective. You also need to consider the time horizon. Do you want it in a short term? Do you want it in a medium term? Do you want your returns in the medium term? And are you a person or an investor that has the patience to wait for quite a longer period of time, right? There are some people that have invested in shares this year, and they've actually sold and taken their returns. So those people would most likely not get a 39.92% returns on their equity investments, right? So for those that have been able to wait, till about this time of the year, from the beginning of the year, would have gotten close to that year-to-date figure that we have. So for risk averse, these are people that they do not want to take a lot of risk. They just want to just invest a bit of their money, or just invest in something that would most likely give them returns on their assets, and they will not lose money on any investment. So if that is the case, our advice today is that people who are not risk takers, who would not really like to lose so much of their investment, should do more fixed income, investing in federal government bond, commercial papers, and the likes. And commercial papers too, your investment house, such as Auto Steven, must be able to advise you that, okay, this is a good company you can actually buy, you can actually invest in or not, right? We have about 55% of their money can go into that. And for equities, investing in shares, about 20% can go into it. And we have cash and cash equivalent, because these people, as set of investors that do not want to lose so much of their money, they should be able to stash a lot of cash right in the bank or wherever they want to save the money, right? We have commodities. We won't really advise risk averse investors to invest in commodities, because there's a lot of risks, and there's the knowledge that would most likely be gotten, right, will not be so much. So it's not an asset class in Nigeria where you get a lot of knowledge about, and you can say, okay, with one or two things that I know, I can invest in this. So it is not advisable for risk averse to actually invest in commodities. And for other asset classes like mutual funds that are doing well, a certain percentage, say 5 or 10%, can actually be invested in that. Now, for risk risk neutral are people that so far there will be returns. They do not mind taking risk, right? They do not mind taking risk. So far, at least the return is also juicy. So, and even though they love to get their return, they do not mind the risks and they love to get their returns. They do not also joke with their returns. So this set of people should be able to invest 35% in fixed income instruments, 40% in equities, maybe 5% on commodities, 10% on other asset classes like mutual fund and the likes, and then maybe just owe 10% of their cash just in case of emergency, and in just because of the liquidity, if they are unable to quickly turn their instruments, any of their asset class into cash. Well, equity is quite liquid. You can wake up today to say, I want to sell a certain percentage of my shares in the market, and when you reach out to Otto Stephen, you're sure to get you're sure that we'll be able to sell the same day and get your money in within a few days. So for risk seeking or risk lovers, these are people that are willing to take risk to any length, right? So because they know that the higher the risks you take, the higher the returns you're likely going to get from taking it. So if it works, yes, they have all the returns to themselves. So this set of people can invest like 40% on equities, 30% just to be safe on fixed income, invest 15% on other asset classes. Mutual fund is there. Invest like 5% on commodity, because there is not so much so much knowledge in this particular area, except a person or an investor is willing to dedicate time to study movement in prices of gold and all other commodities. Then maybe owed 5%, depending on the emergency situations that people wants to prepare for. And also 5% can be so little depending on the wealth that a person has, right? And 5% can be so much also depending on the level of wealth. So and across all of this recommendation, time is also of the essence. Are you an investor that wants to just invest in a few months and take your returns, or you want to go a year long, 2 years before you take your returns? So this is also very important. Now lastly, we'll just recommend some stocks that you can invest in. A lot of people knows that Otto Stephen helped a lot with investing in fixed income, all those federal government bonds and all of that. But we also want you to know that we have a trading platform, and you can invest, you can buy and sell your shares. And if you're having any difficulty, we have the sales team in-house that when you reach out to us, they can easily help you with all of this. So of course we have Okomo oil, and there's a possibility of 10% upside. This is using the fundamentals that Dr. Agama has explained earlier. So all of these things are available: Okomo oil, Cadbury, Dank Sugar, UBA, Zenith Bank, GTCO, MTN, WAPCO, Dank Cement. This will be sent to all participants of this webinar today. If you're not on our mailing list, just reach out to us via email or via WhatsApp. Send us your email and we would add you to our mailing list. Right. So moving on, that is right about that. We want to leave enough time for people to actually ask questions. So the floor is open now for questions. Dr. Agama is here to answer questions. Mr. Amolek Batu is also here, and likewise, I am here to answer questions. But majorly, Dr. Agama will be answering all of our questions. So this is our location, our emails, and the phone numbers that you can contact. You can either screenshot or quickly pen this down if you've not actually seen it on the chat box. So you only those that are asking questions should unmute, and you can also signify by giving a reaction, maybe raise of hand we'll call you one after the other to answer questions. Thank you so much for staying with us till this time. Now the floor is open for questions and answer.
Tolu, there are a few questions that I can see in the chat box. You might want to start with those, all right, before you go to people that might want to ask questions. I'm
Yes,
seeing a
thank
few
you.
questions on the chat box, so you might want to start with those.
So how do we buy gold to diversify our portfolio? How do we buy gold to diversify our portfolio? So let's take it from the beginning. I'm trying to scroll through. Yeah, thank you. How does exchange trading funds work? Okay, so Dr. Agama, somebody is asking, how does exchange traded fund work?
So the exchange traded fund are baskets, they are more or less derivative instruments that are reflected by the underlying in that basket. So there are some capital market operators that actually have ETFs. I know that Vertiva has the ETF Gold and some others too. So you can actually reach them to be able to buy. And because what it is that when an instrument's price is determined or reflected on the price of the commodity, the movement of price of the commodity will also, influence the price of that particular kind of security. So more often than not, people invest in ETFs because of the opportunity of diversification and risk curtailment in those instruments. So they are available, and there are some very good ones even in our market. Yeah.
Okay, so there is one interesting question here. Daniel Imo is asking about stock recommendation that really gives, the expected returns before another week. So I think this has been inferred during the presentation, but doctor can actually answer this. So before is 1 week. So I'll ask this question: is 1 week enough for any stock that was recommended to actually give the expected returns?
Well, the fact is, it is not Kalu. You must be patient when you are in this market. It's only in Kalu business that you expect a return immediately, or you do the Onitsha sales syndrome. The Onitsha sales syndrome requires you to make profit immediately after selling, and 100% for that matter. So when you are in this market, it's a knowledge market, it's a sophisticated market. It requires you to be patient. Patience is a virtue. So we all must try to be patient and be, long-termism is what pays off more in the capital market, so that you don't give yourself high blood pressure, believing that you want a return almost immediately. But anyway, there is an investment strategy that I normally apply, which is called scrapping. Scrapping requires you to come out of an investment even 1 week after, but with very little return, and you go back again if that is exactly what you want. So, but importantly, always reach out to your stockbroker, financial advisor, accountants, lawyer, and you get solid advice.
Okay, so there are two more questions that are similar here, so I'll put them together. So this person is asking, just inferring that when GSK announced its exit, there was price appreciation, and PZ is also on that, same decision making. And this person is asking if the price will go up. So either to go up or not, what could drive the price appreciation? So I'm rephrasing that. Also, he realizes that penny stocks are experiencing rapid price appreciation. So what could be responsible for that? So what could be responsible for price appreciation of any stocks at this time, sir?
Well, I've said it, the fundamental analysis is good. We talked about value investing, we talked about growth investing. These are fundamental, real concepts that could be applied. And the truth about it is, in any stock, once there is high demand against the supply, then of course the price will move up. So it is economics, simple economics, and that is it. But however, don't take this as a stock advice. Before you invest, go to your stockbroker. Bam.
Thank you so much for that. Okay, are there other questions? Okay, are there other questions, Tolu?
Yes. Okay, so this person asking this question would have been able, if the person had attended our last webinar, would have been able to, get insight into this. So what investment can give returns above the inflation rate? That's the question here.
Yeah, well, there are a lot of instruments that can give returns above inflation rates, and the same thing is, in this kind of webinar, it is important that you reach back to your stockbroker, discuss with your stockbroker, so that the stockbroker will also demonstrate those things for you. Because, of course, if I give you a particular stock now, I will be recommending the stock, which is against my ethics.
Yeah.
Okay, so there's a question based on industry, right? As you explained earlier, Dr. Agama. So this person would like to know if solid material industry is the stocks of solid material industry are a good equity or shares option at the time.
Solid minerals, yes, solid minerals, of course. Imagine if a company is exploring lithium or gold. Those companies, you know the value of those particular particular products or commodities. So as much as the price of gold is improving, fundamental analysis, it shows that the intrinsic value is there, and so the price will go up. So, but you must be clear that it's actually an exploration company, because people may claim to be exploration, whereas they are not. So note that.
All right, thank you, Doctor. So this person is asking what balanced portfolio is. I think when we share the material, I should be able to get that, because Doctor had explained that already. So the second part of the question is the CBN governor's release on bank recapitalization. What impacts do you think is going to have on the capital market and the economy generally?
That's a very good question.
Doctor, did you capture the question?
Is Doctor still with us?
Yes, go ahead, sir. What did you say?
Okay, so the question was CBN release on bank recapitalization. What impacts do you think is going to have on the capital market and the economy in general?
Well, fortunately, I've been in this situation before. I was the head of unit for public offerings when the bank recapitalization by Soludo happened. It's going to bubble. The capital market is going to bubble, in the sense that there are going to be a lot of products, a lot of instruments. But this time around, it's going to be different from the other time, because the other time there were so many. This time there are not as many, so there will be a proper analysis and evaluation, And if more money comes into the banking industry, it means that more money will be available for the capital market. So give or take, it's good news. Besides, if the banks have enough money, then they can have increase their liability, which means loans can be provided for the real sector. And of course, the end result will be, a boosted economy. So clearly for me, it is, fantastic, and it is a good.
Thank you so much, Doctor. So for those that have more questions or that have more questions after today's webinar, you can actually reach out to us, send us an email, or you ask on our WhatsApp community. So if there are no more questions to be asked, we're going to be sharing the material. I believe this is a general question. We're going to be sharing the materials. So this is a given. I would call on Mr. Amolegbe to give the closing remark.
Okay. So before you wrap up, I think that I might as well ask this question on behalf of the participants here. I know that the SEC is doing quite a bit and showing the right concern regarding unclaimed dividends and the fact that it keeps growing. And I'm sure some of our participants too have dividends that they have not been able to collect. I don't know whether Doctor wants to give us some heads up as to some of the things that the SEC is doing in that regard. And what are the new measures we should be looking forward in ensuring that phenomenon of unclaimed dividend is tackled once and for all?
Well, the answer is very simple. I'm sure, Mr. Amolegbe, you were not at the last CMC.
Yes.
So
I participated on that.
Yes, the last CMC explained that the committee is working on updating the platform and making it easier and faster for people to get through with unclaimed dividends.
Mm-hmm.
And of course, more education is important and necessary to get that to happen. All of the challenges that were experienced before now have been taken on board by that committee. And I'm sure by the time they come out with the new results, it will be better off than what it used to be, and to make it easier for people to get their monies.
Thank you so much. So the very, very last question we're going to take before we wrap this up today, Mr. Odedino, I'm giving you the privilege to ask the last questions because you have always been a regular presence at all our webinars. So please go ahead, please.
Thank you very much, sir. Mr. Tunde Amolegbe.
Yeah,
my question is basically in respect of dividend paid by Okomu. There were a lot of errors. As I'm speaking to you, I got paid for just 2 units, whereas I have more than 2 units. The dividend per unit.
What you need to
So what do you advise investors to do?
You write to the commission. Attention, head of enforcement. So they will look at it and then call them to order.
Okay.
Yes.
Okay.
But
thank you very much.
before you write to the commission, my advice is to reach out to them also. Maybe the mistake was not deliberate.
It's actually it appears to me to be a universal mistake they made, because they've actually called me to. In my case, they actually paid me more than the shares that I had.
So return the money to Mr. Odedina. With the
Yeah.
money and paid you. You return the
so it appears that it was a system error and they are trying to correct it one way or the other. These things do happen, so they are making an effort to straighten it out. That much I know. So I will advise Mr. Odedina, just be patient with them. Thank you so much. Thank you, Tolu, and again, thank you so much, Dr. Agama, for the wonderful work you've done with us today. For the presentation, for taking time to answer the question. My hope is that, the fact that we had 38 people going into this, and There are 42 of us now, and we've been on it now. We've been on this now since 2 o'clock. That's 2 hours, and everybody stayed. Which says to me that they've really thoroughly enjoyed your presentation and your company today. So my hope is that the next time we call you, you'll still oblige us and join us on this series
No problem.
very soon.
Okay.
Thank you,
Bye-bye. Yeah.
thank you so much, Doctor, and it was a pleasure having you. And so over to you, Tolu, to bring the webinar to a close.
Thank you, everyone. We appreciate your presence. Next year is another time we are going to be having more webinars. And for those that have not dropped their email, you can chat us. Our email address has been dropped on this chat, also our contact. So if you registered for this webinar, be sure that we're going to be adding you to our mailing list so that you get updates on the market regularly, as it is our custom. So we attend to people individually when you call. Also, for those that have not opened accounts with us, we want to enjoin you to come and enjoy what our clients are enjoying, right? Timely information, questions being answered, education from periodic webinar and the likes. So we would like to have you to be part of the Otto Stephen Assets Management Limited family. Thank you for your time. Have a wonderful time. Enjoy the rest of your day and the rest of your week. Thank you so much. Bye.
Thank you. Bye-bye. Bye-bye. Bye-bye, everyone. Thank you very much.
Thanks a lot, Mr. Amolegbe. Thanks to Lu.
Thanks,
Mr. Gama.
Thank you. Thank you
Bye.
so much. Thank you. Enjoy the rest of your evening.
Thank you. Enjoy your day too.
Thank you. Thanks for coming. Thank you.
Bless you and your team.
Thank you so much. Thank you for coming.
I appreciate you always.
Thank you. It's a pleasure. It's a pleasure, sir. Thank you.